Hey everyone, welcome back. And today we're doing another company stock analysis. And today it's going to be something that's really popular and on everyone's minds. It's going to be Microsoft. So I'm not going to spend too long talking about what Microsoft is, right? We all know the cloud, the Office, personal computer, Xbox, LinkedIn. They got all their hands in all these pies. Everyone knows what Microsoft is. Even if you don't know exactly what they do, you've definitely used their products. So let's just jump into the headwinds and the tailwinds, right? So headwinds for Microsoft. One of the big ones is regulation because of how big they are. There's no other real headwind that's I can see that's very concerning or even something that needs to be brought up with regards to Microsoft, which does give me a little hesitancy because on worse things. But we also know that they have AI, which means a decrease in free cash flow because of the capex. So that's definitely something that's coming up in the future or currently happening right now. Tailwinds, right? That this is going to be something that pushes Microsoft even further forward. AI making their products even better, making users want to keep using their products. And that's always going to be something that in capitalism, as a capitalist society, we want, right? We push society forward with good, better, and better technology. Cloud, right? They have a really big margin on cloud, and that's also growing super fast, which is it's one of the reasons why Microsoft stock actually jumped after earnings. So finally, one of the big, I think this is something that isn't talked about as much or nearly enough, is the switching costs off of Microsoft. That really means that Microsoft has that stable core base of users. So you're always going to get that revenue in, year out, no matter if it's rain, shine, hail, snow, whatever. That's a really big tailwind for the stock because it allows for people to more accurately predict what Microsoft is and doesn't require and it requires a smaller margin of safety for people to actually jump in the company. So revenue and profit history, right? Revenue growth, I mean, it's great. It's 15% over the last 10 years, 15% over the last 5 years. It's just a straight line up, exponentially growing at 15% a year. Nothing else to be said. Earnings is a bit more volatile simply because of the margins, right? Margins have fluctuated between 30 and 40% essentially. They've really stable around like 35, 36%-ish. Right now it's at 36. 10-year median PE is at 30, 10-year average is 27. Of course, this is also going to be taking into account a bunch of years where people didn't think of Microsoft as having the type of stability as it has now. So today, the PE that we probably want to give to Microsoft is going to be a bit higher than the PE maybe like five in history, right? So I do see a 15% revenue growth. I do see margin sustaining at around that 35.5%. And in PE, I do see it at least at a 35, right? I'm going to be on the lower end because I do want to make sure I am not losing money. But at 35, due to a higher predictability in the company, that still gets it to a very respectable value of interest price today of $460 or about $470. That's a nice price, right? Those of you who know the Microsoft price might see this and wonder, what am I talking about, right? But let's go over to free cash flow and we'll see something else, right? It's not really that much different of a story. We do see that 18% 10-year growth and 5-year CAGR of 10%, right? It's a really quickly, uh, quick cash growing company. 10% year on year, 10-year median 31, 10-year average 38. Once again, because of its consistency, I do think we are going to be required to give it a more premium to the market. Even it is trading at a premium now, but I do think the consistency now gives it a premium to even itself, especially if it's able to sustain this type of growth and this type of consistency over the next 5, 6 years, 2, 3, 4, 5 years, right? Especially if there is a downturn. So what am I really assuming here for Microsoft? So I do see of 18% growth. So this is because that we are from the previous slide, we do see that free cash flow isn't at its peak right now. I do see that we're able to grow faster here, back to the peak, and then sustain a 10% growth rate. And then because of that sustained growth and that consistency, I do see a price of free cash flow that is higher than the current. Uh, I don't know why that's labeled that way, but that should be saying that price of free cash flow $45 per share. Price per free cash flow due to not lowering of free cash flow, but a sustained free cash flow, right? A higher price of free cash flow than what it's previously had. So what that means is an intrinsic price of $530-ish, accounting for that $8 per share of debt, which because we're calculating this for free cash flow, we do have to account for that. Finally, dividend, right? This is a company that pays out dividends. This isn't a company that you're looking at for that dividend payout, especially to live off of. It is a company where dividends are a bonus, not a requirement. So a 10% growth is saying they sustain the current yield of about 2/3%. That really gives us an intrinsic price of about $400, which is on the lower end, which makes sense, right? Your dividend yield is not growing as fast as your earnings, it's not growing as fast as your free cash flow. So if the yield stays the same, then obviously you're going to have a lower price than the other two are going to calculate out, than what the other two are going to calculate out too. So overall, what do I think of Microsoft? I think revenue out of the overall target right now, I think it's probably worth about $440 to me. A target price for 2026, I do see that 506, and at its current price of about 498, it is definitely most definitely a hold. I do see about a few percentage point upside to the company in the next year, but we'll see where the AI boom and bust cycle actually takes us. It is possible that Microsoft being one of the visually visual winners of AI can explode, right? Especially if they open AI as well, especially if other companies don't do nearly as well. But then again, on the flip side, it is quite possible that their cloud business slows, right? If their revenue does slow down, we could see a pretty fast deterioration of how people view Microsoft, especially if their consistency does get eaten into. So I do feel that that $506 target for next year is reasonable, if not on the conservative side. So thank you guys for watching. Leave a like and subscribe if you enjoyed, and let me know what I can do better and what other companies you guys would like me to investigate. Thank you so much.